China's role as the world's manufacturing hub has undeniably been significant. It's remarkable to see how many jobs and production activities worldwide depend on China today. The country has always been the preferred destination for large companies seeking to manufacture their goods. Now, it's not surprising that the majority of the tags and labels we see on products bear the words "Made in China." However, China's economy, which is the second largest in the world, has been slowing down. This year was supposed to be a time when China's economy would get better after dealing with the COVID-19 pandemic, and there was a lot of optimism around it. But things didn't go as planned, and now China is facing some problems. In this episode, our focus will be on China's economy and the various aspects impacting it. We'll delve into the GDP numbers, retail and property sales data, and employment trends. Now, China's slowdown doesn't just affect China itself, it can also impact the whole world, including India. Now, many countries depend on China for their products, so if China has problems, it can affect other countries too. Now, in this episode, we'll also try to understand how the slowdown will affect other economies. Let's begin. You're watching Informed Investor, an initiative by ResearchAndRanking. The latest China GDP numbers that came early this week have been so concerning that even the US Treasury Secretary Janet Yellen said that the slowdown in China could likely pose a risk to the global economy. So let's break down what's really happening in the Chinese economy. In the second quarter, China's economy grew by 6.3% compared to the previous year. At first glance, that may not sound too bad, especially since the world economy is only expected to grow by a small 2.8% in 2023. But here's the catch. Last year, China had strict COVID-0 rules, so comparing the numbers isn't exactly fair as it gives a low base for comparison. Also, do know there was a time China's economy would see double-digit growth rates. Moreover, economists had predicted a faster growth rate of 7.3%, but China fell short of that mark. Now, because of this, several economists have downgraded their forecast for China's economic growth for the whole year. Now, big banks like JP Chase, Morgan Stanley, Bank of America, and Deutsche Bank are now projecting a 5% growth for China this year. Now, let's talk about two other important indicators, property and trade. China's exports, which play a huge role in their economy, have been declining. In June, they experienced the biggest drop compared to the same time last year since the pandemic started. China's exports fell by a steep 12.4% in June 2023, and in May they already dropped by 7.5%. The real estate and construction industries are also other essential parts of China's economy, making up at least a quarter of it. Property sales have been falling significantly, and real estate investments have been declining as well. According to Reuters, property sales by floor area fell by a large 28.1% in June compared to the previous year, which was the biggest drop of the year, and it got worse from May's 19.7% decline. Similarly, real estate investments declined by 7.9% from January to June this year. Now, these numbers are showing that the property market in China is facing a downturn, and it's impacting Chinese developers who are already dealing with heavy debt burdens, sluggish demand for new property, and potential home buyers who are more focused on saving during these tough economic times. Now, moving on to consumer spending in China. Retail sales have shown slow growth too. In June, they were up by only 3.1% compared to the same time last year, a significant drop from the 12.7% growth seen in May. Additionally, the unemployment rate for young people aged between 16 to 24 reached a new high of 21.3%, while overall urban unemployment remained stable at 5.2%. Now, all these signs indicate that the current economic situation in China is disappointing, especially when there was so much optimism from the world about China's post-COVID recovery. Now, the GDP growth didn't meet expectations, demand for exports has been falling, the property sector is experiencing a downturn, and unemployment rates are high. Moreover, while most countries are facing high inflation, China is facing deflation, which can severely affect its economy. And if you do a quick Google search about China's economy, you'll find tons of articles and opinions talking about its slowdown. Now, it's definitely become a hot topic now. Some people think it's just a temporary hiccup, while others believe there are more deep-rooted issues causing this. Now, we can't help but wonder if the mechanisms that led to the Chinese miracle, that incredible transformation over 3 decades that turned China into a global powerhouse, might be faltering now. Of course, we can't say that for certain. Now, predicting long-term economic performance is difficult and open to debate. But there are some factors that suggest this slowdown is more of a structural problem rather than just a passing phase. Let's discuss those factors. The current state of China's workforce and demographic situation is having serious effects on their economy. Now it's like a double whammy. The workforce is shrinking and the population is decreasing with a drop of 850,000 people last year. Now with fewer people in the workforce, it's affecting how much labor can contribute to the overall economy. On top of that, the dependency ratio in China is going up, meaning there are more retirees to support with fewer working individuals. Now, this creates a tricky situation for trade and domestic demand. Now, you see, as the population's consumption starts to exceed what's being produced by the working folks, there's a mismatch. And that's a problem for the world's second largest economy. In the past, China invested in domestic businesses through state-owned banks, but with the changing demographics and a potential drop in savings, the government needs to find new ways to finance investments in the private sector. Now, the thing is, the state's strong intervention in private industry have made things complicated. We all know how the government's regulatory campaign on private-run internet giants have had a chilling effect on China. Now, it hampers private investments and puts constraints on the domestic economy. In May, private sector investments declined for the first time outside of the initial 2020 COVID shock. Now, the 0.1% drop wasn't big, but it's unusual in the economy that's supposed to be rebounding very strongly after the end of pandemic lockdowns. In response to a slumping economy, China's central bank is taking the opposite approach to some Western countries by cutting its main interest rates to try to stimulate investments in its economy. Now, just days after a slew of economic data showed growth momentum has slumped, China has also promised to boost its private businesses. But whatever happens now, you can bet that China's economic performance will have a significant impact on global growth. Now, it's a big player on the world stage and its future matters to everyone. Now, since joining the World Trade Organization in 2001, China has become more and more connected to the rest of the world. It's now at the center of the global trading system, even surpassing the US. Many big companies like Apple and Tesla have their factories in China. A huge number of jobs in production around the world depend on China. Now, one big way China's growth affects businesses globally is through trade. China's share of world exports has grown a lot, going from 4% in 2001 to 15% in 2021. The IMF predicts that China will be the top contributor to global growth in the next 5 years, making up 22.6% of the world's growth, which is double that of the US. On the back of the challenges China is facing now, even Australia's Treasurer Jim Chalmers has said that China's flagging economic growth is concerning for Australia, as China is its largest trading partner. Now, when we talk about India, the crisis in China brings both challenges and opportunities for the Indian economy. Over the years, India's trade with China, especially imports, has gone up a lot. In fiscal year 14, about 10.7% of India's imports were from China. And by fiscal year 21, it increased to 16.6%. However, it has now come down to 13.8%, but this is still a big number. On the other hand, India's exports to China has also dropped from 5.08% in fiscal year 19 to 3.39% in fiscal year 23. Now, India mostly exports chemicals and mineral fuels to China, while it imports electrical machinery and electronic goods. Now, this crisis in China could impact India's trade as India relies on China more. But the situation also presents an opportunity for India. India can look for imports from other economies, reducing its reliance on China in the long run. It can also work on building its own capabilities to make these products domestically. In fact, India is already benefiting in certain areas. Take, for example, solar exports. India used to buy a lot of solar products from China, but now things have changed. Domestic manufacturers in India have stepped up and started making their own solar products. They're not only meeting India's need, but also exporting them to other countries around the world. According to ICRA, India's solar cell and module exports by its own manufacturers were worth rupees 8,840 crore in fiscal year 23. This is a huge 364% increase from rupees 1,819 crore recorded in fiscal year 22. This new opportunity for India came about because of the ongoing issues between China and the US. In fact, about 97% of India's total solar module exports in fiscal year 23 went to the US. The US has accused Chinese solar manufacturers of avoiding trade tariffs. There are also accusations of forced labor in China's solar industry, and some containers of solar products from China are stuck at US ports. So while India used to rely on China for solar products, it's now making its own and exporting them to the world, making use of the opportunity of China's relationship with US. Now coming back to China. China's role as the world's manufacturing hub has undoubtedly been monumental, with many countries relying on its capabilities for production and trade. However, the recent slowdown in China's economy raises concern not only for the country itself but also for the global economy. The latest GDP numbers, declining exports, a downturn in the property sector, and high unemployment rates all point to structural issues that may be impacting China's growth. Now, do know that talking about China's economic situation can be quite challenging. On one hand, the country has made efforts to improve transparency in its financial sector. However, there have been instances in the past where China's GDP data has been suspected of manipulation. This raises doubts about the accuracy and reliability of the data we discussed. Anyhow, the world's factory China has the potential to grow faster than the advanced economies for decades if it can act quick and overcome these challenges. And of course, whatever happens to China is likely to have a major effect on the global growth. Having said that, this is me, Merlin Susanna, signing off. Take care and stay invested.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.